I'm Sarah Borkson-Keto here in New York for REIT Week 2019, NAREIT's Investor Conference. I'm joined today by Jason Fox, CEO of WP Carey. Welcome, Jason.
Thanks, Sarah.
So WP Carey has really evolved over the last few years. Can you talk about some of those changes and what you see as the focus going forward?
Yeah, sure. I mean, we've really made a number of structural changes, really since becoming a REIT in 2012. We've focused on our balance sheet. We've built a strong and flexible balance sheet, rated investment grade. We've also focused on our unsecured strategy, and we have really broad access to capital markets at this point in time. We've also focused on simplifying our business. We were at one point more of a hybrid between a REIT and an investment management company. At this point in time, we've really shifted our revenue mix to about 95% generated from our real estate investments. A much more stable cash flow, higher earnings quality that is more highly valued from our investor base. And we've become a more efficient company. We've lowered our G&A over the years, and with the enhanced scale resulting from our merger with CPA 17, we're a more prominent REIT, and we have significantly more attention from the investor community. All of that has led to where we are right now, and at this point, the focus is on growth. We have a favorable cost of capital at this point in time, which allows us to generate wider spreads for the investments we've always done, but it also allows us to expand the opportunity set to perhaps lower yielding deals that can provide perhaps higher growth or higher quality. We've also have the infrastructure in place within our investment team to do large volumes of deals. And of course, being focused on diversification offers us a wider opportunity set to really allocate capital to the opportunities that we think are going to provide the best risk return.
Now, you mentioned diversification. The company's diversified across property type, industry, geography. Why do you really view that as the best approach?
Yeah, we've always focused on diversification, and we think that it lends itself quite well to net lease investing, where there isn't really a daily property management aspect to net lease. That doesn't mean that we're not proactive asset managers. We think that's an important component. But generally speaking, diversification, certainly on the downside risk, we're not overexposed to any one sector or asset type. So it provides some protection in the event there's a disruption in any particular area. But on the growth side, it provides us with a broader opportunity set from which to choose our investments. Now, it's not a go-anywhere approach. We think about diversification. We're focused geographically on the U.S. as well as Northern and Western Europe. We have a platform to generate new deals and to manage our portfolio. We also like industrial assets. Almost half of our portfolio this time is within the industrial asset class, and we're able to purchase those assets through sale-leasebacks mainly, where we're not competing with the market. That's also the space where we've seen the most capital inflows. We've been underweight retail, and I think that's been our thesis for quite some time. And then lastly, we focus on critical operating assets that allows us to have better lease end results, as well as, again, provides us with some downside protection.
So unlike some of your peers, WP Carey's focus is not limited to investment-grade tenants. What do you see as the advantages of that approach?
Yeah, when you think in net lease investing, many of the companies do focus on the investment-grade space. It's become quite crowded. It's where there's been the most capital inflows. It's also where there's been the most yield compression. We instead focus on the just below investment grade credit space. We think that's the sweet spot in net lease investing, where our credit expertise, underwriting, and structuring really can provide us with the best risk return. We've also looked at our portfolio and have done some default studies over the years. And what we found is that our defaults are roughly in line with the WP portfolio, perhaps even a little bit better. But where we've excelled is on the recoveries because of our credit picking, the structuring, buying critical operating assets. Our recoveries have been significantly higher. So our credit losses are much more in line with an investment grade portfolio, call it BBB, maybe even BBB plus. So the bottom line is that we may be focused on sub-investment grade, we can earn those type of yields, but the actual risk we're taking is more in line with an investment grade portfolio.
Great. Jason, thank you so much for coming.
You're welcome.
And for more on REIT Week 2019, be sure to visit NAREIT's website, REIT.com.